How's everybody doing? Louder? Not loud enough? Is that better? Better? I'll keep it close to my mouth. Well, firstly, just want to say, appreciate everybody making the trip to this evening on a weekday. I know some of you have traveled far to be here. Really appreciate it, and thank you. First thing I'm going to say is, I'm not going to talk for several hours this evening. We are going to eat soon. I know it's 7 o'clock and we're probably ready for dinner, so we'll be sure to eat very soon. You'll hear me talk for about 20 minutes, then we'll open it to some questions. So, many here, or some here, know what I do, right? Which is the infinite banking concept involved in the financial services and insurance industry. So before we get into this concept, what it is in this presentation, I'm going to start with a story, which is how I was initially exposed to this concept. So, several years ago, I was working at an office when I worked for someone else. And in the office, right, we had this book, and a prospect walks in, and he has this book with him, and has not met any of the agents. No one, the owner, hasn't met him in person at all yet, and states, I read the book, I'm going to put $100,000 a year into this thing. Throws the book on the table. Right, I'm 24 at the time. Okay, that's interesting. Like, what is this? Right, I want to know more about it, right? This Becoming Your Own Banker. We've got several of these books. If anyone wants a copy, they are complimentary. So this whole Becoming Your Own Banker, and then we've got tax-free there as well, right? Revolves around what's called the infinite banking concept. So that's what we're going to discuss this evening. If you have questions, we will open it up at the end of the presentation for questions. So firstly, we've got here, what is the infinite banking concept? And really what it is this is a strategy or a concept that teaches one how to use a cash value life insurance policy as a financing tool. And you'll see that a cash value asset is very similar to real estate. Right, so we've got a piece of property here. Who here owns property or invests in real estate? A lot of us. Right, so if we have a piece of property, and let's pretend that it appreciates at 5% every single year like clockwork. Zero fluctuation, that value goes nowhere but up. If you ever take a mortgage or a line of credit against that piece of property, will your value, your home value, ever be impacted? No. If the appraisal value goes up, it doesn't matter if you own it free and clear or if you have a mortgage against it. You're going to find with this concept, it's the exact same thing. Our money is always going to stay at work for us. That's where our big draw is. Go on to the next slide. So we've got a question here, and this will all tie together, right? Is what do the wealthy do with their money? We've got an interesting statistic here, right? Is when you look at, especially major banks, Fortune 500 companies, the 1%, you'll see in many instances, especially with the big banks, that their number one asset is the cash value holdings, their life insurance policies. Or often number two is real estate. Right, so we see these big banks, corporations, people using life insurance, not always for the life insurance, right? That's something, hey, I don't care about that. I want this cash, right? How's it work? This is what I want to use. So let's go on to the next slide, thanks. Why, right? We get that question all the time when people call our office or reach out after seeing some of our videos. Okay, I'm seeing this concept, like, why? Why do people put money in life insurance? I don't understand it. So a couple core benefits to a cash value life insurance policy. We've got safe, liquid, meaning I can get to it anytime I want, and tax-free. Right, that's a nice feature. We've got returns here, a range of 4 to 6%. And then we've got a little note there that 4 to 6%, right? If I take one of these policies and I do everything right, I set it up right. So we're going to go into the design, meaning I don't really care about the insurance, I'm after the cash. If I use one of the top 4 companies, right? There's a lot of insurance companies out there. You don't need me or anyone to tell you that, right? There's more than we can count. There are really 4 companies which we're going to see a piece on that. They're Mass Mutual, Guardian, New York Life, and Northwestern, cream of the crop that have always paid the highest returns. And this 4 to 6%, right? This is our net. Here's what I can expect to earn year over year. What's interesting about it is that it is consistent. It's a fixed asset in a sense, right? When the economy is doing well, when the market's booming, people with these policies, from a return standpoint, 4 to 6%. 2008 occurred. People lost money in the market. People with these policies earned 4 to 6%. So from a return standpoint, we see that it's a fixed asset. We can move on to our graph here next with our neat handwriting. So when you take a whole life insurance policy at its core, right? A lot of you may have been exposed to whole life insurance that have not spoken with me or anyone in my office before. A couple of key pieces here. In red, we've got this word everyone knows, premium, right? Insurance premium. With a whole life insurance policy, that premium is level for the life of the policy, meaning it will not increase as we grow older. Now, one thing to clarify is with a whole life insurance policy, we do not have to pay premiums our whole life. For a lot of times we see these insurance policies, the question we always get is, I gotta pay into the thing forever, right? No, we can customize these, or they can be customized, I should say, where we can fund it with a lump sum. Maybe it's 2 years to a certain age, we can adjust our contributions. We really look how to take this insurance product, which is boring when we hear insurance, and turn it into a flexible savings asset. In blue, we've got our death benefit. This part is pretty straightforward. If we die, our beneficiaries receive the life insurance amount, income tax-free. And then in green, we've got the cash, right? What's referenced as our cash value. And this is the #1 driver. Everyone that calls our office, we hear all the time, hey, I don't care about the insurance. How do I get that? How do I get it quickly? The cash value. Let's look at some bullet points here. Is when we take a cash value life insurance policy, first thing we've got, no risk, right? Meaning our money is not invested in, tied to, linked to the stock market at all. 2, you'll see a guaranteed cash value interest rate or a minimum floor, often of 4%, especially with those top companies. Also with those top companies, these are 2019 rates. You see their total dividend interest rates range from about 5 to 6.4%. Number 4 is probably my favorite piece, flexible contributions. Right, so again, taking this insurance policy, because this is what this whole concept revolves around, taking the insurance piece out of the equation and making it a cash asset. That's what I want, right? I want to be able to use my money. So if I just have an insurance policy, I pay a premium. Boring, right? With these accounts, I can design it where I start out, maybe I pay in a $5,000 contribution. I have a good month, cash flows up in the business. I want to throw in another $30,000. I can do that. I have a bad month, I can't fund it, I can pay in 0. Point being, I can add to it at leisure, and again, take this, what's traditionally a fixed, rigid, boring product, and make it a flexible savings asset. Right? I want to be able to be creative with it and not be committed to this big bill. Contributions with these accounts are made with after-tax dollars, so I cannot deduct them like I can with a 401k. The growth is tax deferred, so as it grows, I do not pay taxes on the gains. And the money can be accessed 100% tax-free if I do everything properly, right? And we'll show you exactly what that means here as well. And our last bullet point is that there is no lost opportunity cost, right? And that comes back to the concept, right? If I can earn 4 to 6%, that's great, but how do I at the same time use that money and invest in a piece of property? Invest in my business where I'm really going to drive my returns. So here we've got two of the top 4 companies, Mass Mutual and Guardian. We've got printouts as well. I know the font here is a little bit small. This just shows you some history as far as what they've paid. You see their guaranteed interest rate and also their total dividend rates. All right, the design. Right, so if we ever look into a life insurance policy, right, because this stuff can be confusing, this is probably the most important piece, right? If you pursue a policy today, 15 years from now, just think the design, that's the most important piece. This is the number 1 takeaway I'm going to take from this evening, is when I actually pay money into one of these policies, I can determine where my money goes. There's 2 areas at the end of the day. We have our insurance premium. I'll often refer to that as our insurance expense. You'll see dollars that I pay towards this premium buy me life insurance first, a death benefit, and then eventually build cash value. And then we've got this technical term, PUA rider. We just call it cash, right? Money that I allocate towards cash, guess where that goes? Cash. Money that I can access anytime I want. Money that begins to earn interest immediately. This is the key really to maximizing the returns, right? Because to practice this concept, meaning use my policy as a financing tool, the first thing I've got to do is build up my actual equity in it, my account value. So really where we specialize in our practice is how do I get that account value up as quickly as I can so I can use the money as quickly as I can. This is a question we get frequently. How do I put all of my money into cash? All right, I don't care about the insurance. How do I just put it into cash? So we get as much as we possibly can into cash. However, there are limits. 2 limits you want to be aware of. 1, we have the insurance company. They're actually going to have a limit. So again, our money can go where? Insurance premium or cash. Always remember that. Premium, cash. Premium, cash. Wherever I set my premium, that expense, a company will allow you often to pay up to 10 times that number per year. It can be at your discretion, so it's not required, but that's how much I can throw into the cash feature. Right, so if I want the ability to pay in $100,000 on any given year into a policy, what that means is I need a minimum insurance premium expense of $10,000. So what I'll do is commit to the minimum, and then at my leisure, add more money into cash. Right? I don't want this big bill commitment. Then the second limit we have, these guys have limits on everything, it's from the IRS. Right? So the IRS limit is what is called a MEC, a MEC limit. It stands for Modified Endowment Contract. So again, a big benefit and a huge draw to these policies is that they're tax-free. Right? They're safe, but the tax benefits, that's where we see so many people shoveling money into these accounts. Any life insurance policy can become classified as this modified endowment contract, this MEC. And if it does, all of those tax benefits that come with the cash value of the life insurance, guess what? They're out the window, right? We can't use it anymore. We can, but the treatment is going to be very similar to a 401k. Not in the sense that we can deduct contributions, we cannot do that, but more so in the sense that the growth is tax deferred. However, if we touch it, we have to pay income tax on the gains, 10% penalty. It's just not attractive. Really abuses the plan, messes everything up. Right, so how do we prevent this taxable event? Well, every policy has what's called this MEC limit, which is exactly what it sounds like. It's how much money I can pay into the account per year and ensure that it's still a tax-free asset, not a taxable asset. And what most are not aware of, anyone who's worked with us is aware of this, but we can set that limit at any dollar figure we want. So if one says, I want to pay in X amount of dollars, the first thing we're going to do is set that limit at X amount of dollars. That means I can use this truly as a tax-free savings vehicle. So we're going to look at a couple samples, and again, we've got printouts, should be on the table. If not, we've got plenty of them up front that you can take out with you. Yeah, the table's perfect. So what we're going to show you here is, firstly, a traditional policy. And this is what we'll refer to as a great example of what not to do. Right? Has anyone ever been presented whole life insurance, not from me or my office before? In here? Got someone in the back. Perfect. Another one. So typically, this is what is presented when whole life insurance, when that word is mentioned, right? Ah, that's a horrible place to put money. And we'll show you exactly why. All of our money in a basic policy goes towards the insurance premium, meaning it buys me a death benefit, zero cash in the beginning or a couple $100, and then eventually starts to build up. And then we're going to look at a properly designed policy, which is how do I get that cash right now? How do I use it? How do I stop funding very early if I want to? All right, so let's view the examples here. Firstly, great example of what not to do. So if you've got those printouts, this is going to be a 45-year-old male. You're going to see $20,000 a year going into this account. And it's in red for a reason. I pay in $20,000. How's my cash value look in the first 2 years? Who wants this? We won't sell it to you, right? So we put this money in, year 1, year 2, I've got nothing to show for it. The reason why, right, this helps us understand where the insurance companies make money as well, because we know they're good at that. What the company is doing here is they are overcharging us for this insurance premium up front, really in the first and second year, and then eventually we're starting to build cash. We've got this cash column in red until year 11, because I finally got a gain at that point. All right, I've now paid in $220,000 and I've got $221,000. Who wants an $1,100 gain after 11 years? No. So great example of what not to do. Perfect. Let's progress on to the next sample. And again, these are samples, right? When we design these, it's all ratios, right? We can take these samples, we can add a 0 onto them, we can take a 0 off. If the ratios are set up right, these policies work, and they mimic what a lot of these institutions do. So here is an example, same 45-year-old male, paying in just $50K a year, and he's going to stop after 5 years. We could stop after 2 years here if we wanted to. First thing I want to highlight is when you look at this chart, before you look at that blue column, on the left, you've got where it reads that base premium. That's our insurance expense. And then you see our cash contribution. Here we're maxing it out. We've got our total contribution at $50,000, the insurance expense 10%, 5K. Right? If I'm paying in $500, that means I want my insurance expense at $50. If I'm paying $5,000 in, and my expense at $500. Minimize that, that gets more money into cash. As a result, I now see a positive return between years 3 and 4, highlighting in yellow, right? Year 4, that's where I've got a gain finally. The death benefit, I don't want to get too technical, that is set at an oddball number, right? $1,050,000. What that has to do with, going back to that taxable line, right? Again, when people we work with, they're not interested in the death benefit, we're getting the minimum insurance we can to still keep it classified as life insurance, so the IRS views it as tax-free. So our MEC limit here is $50K because we're modeling a $50K payment. And then the far right, we mentioned between those 4 to 6% returns. That's what we've seen historically. You're going to see this illustration falls right in there. You've got the year over year, our annual returns. And on the far right, we've got the average, which we're factoring in the first year where we're negative. That's why it takes a little bit of time to make up for that loss. Green check mark. Using the money, right, the home stretch here, right, then we can eat. So there's no lost opportunity cost to these policies, right? That's the big thing. Going back to that property example, if I own a piece of property and it does nothing but appreciate, right, I can take a line of credit against that and I still get that 5%. in a perfect world. So a lot of accountants we've actually worked with, CPAs, have described in this way. I've liked it, so we tie it into our verbiage. It almost becomes a personal line of credit, right, in a sense. Once I build up that equity, I can stop paying, I can keep feeding it, but it's a line of credit in the sense I can dip into it when I want. The bit more flexibility is that I own it. I can pay it back whenever I want or not, which we're going to look at a model here next. So again, this is small up here, so that chart you've got will be helpful here. This shows same 45-year-old male paying in $50K a year. Right after 5 years, he's got $250K. The example on the left just shows pay money in, let it sit and grow. And we're going to compare that with the example on the right, which is the identical policy, except we're going to use it here. Right, so firstly, whatever I have in cash, if I want to take it out the first day, I could. Whatever I have in cash, I have access to. There's no penalties or restrictions as far as what I can access. Here, we pull out $200K, right? It's in year 5. What we want to look at is first in green, your cash value. Again, that's, call it your line of credit. We pull the money, you see your line of credit dip. The cash is what we can access. Now, the insurance company is going to say to you, I'm still going to pay you interest on anything in cash. I'm still going to pay you that 4 to 6% on the 200 you pulled out, right? So how and why do they do that? So look at the death benefit on the far right compared to the example, year 5, where we just let it sit and grow. What you'll find there is there's an exact $200,000 reduction. I pulled out $200,000. The insurance company is holding my death benefit as collateral and still paying me interest on my cash. Right? Remember that the insurance company's first and foremost obligation is to pay out life insurance claims. Right? So if we die with a loan outstanding, what would happen there is that the company would still pay out a claim minus any loans we have outstanding. When the loan is repaid, we can pay it back over any pace. You don't have to at all, which we'll touch on last. But look at year 10. Right? We pulled out $200K, eventually paid it back, and what does your cash value look like? And what does your insurance look like compared to both examples? Identical, 0 change. Right? Again, it's just like that property appreciating at 5%. I pay the loan back. Everything's fully restored to exactly what it would have been if I never touched it in the first place. Same thing here with the second loan. Doesn't matter on the payback schedule. So with these loans, right, we hear the word loan. What comes to mind usually? Interest, I heard. Payments, right? Got to pay it back. Whereas life insurance loans, there's no requirement on those repayments. You'll see a lot of times these are even positioned where people will overfund these policies. Maybe they'll borrow, like what you see here, but it's more so just as a retirement play. Here's an account, a safe account. I can park my money and then turn around and take income on a 100% tax-free basis and not have to worry about it, right? They're taking out loans without paying it back. What ends up happening is a lesser death benefit is paid out. So, before we eat, that's it. Thank you. Any questions? We can do a little bit of Q&A before we eat. Any questions that anyone had? One in the back. John?
Say I take out a loan, right? I have cash value. Maybe it's something that's like a payment schedule or a payment book you have to sit to pay it back.
Yeah, good question. So his question was, if I take out a loan, do I have some kind of payment schedule that I have to pay the loan back? The answer is no, right? So going back to that retirement strategy where we pull income, right? There's no payback requirements at all. If you wanted to, you do have the option to set up a regimented payback schedule. Some do that, that just like to be disciplined in that sense. Good question.
How much in cash value could I actually pull out and borrow against?
Yeah, so whatever you have in cash, typically 98 to 99% of that. You always want to leave a small percentage in there, especially if you pay nothing back, just to prevent a policy lapse from occurring. But whatever you have in cash, you have access to anytime. John? Yeah, good question. So when we take a loan, his question was, are they going to ask me what the money's for? Because we've got the word loan there. Typically we have to qualify it for it. No, not at all. So when we want to access it, whether it's a withdrawal or a loan, literally how most companies work now, I can go on an online account, punch in the amount I want, and they send me a check or direct deposit. It's fairly simple. Eric? 3 to 5 business days. Yeah, sometimes it's 1 to 3, but give it a little more time, 3 to 5.
So, it's earned income, you're putting it in the account for cash. You don't pay tax on that money that you earn that year?
Correct. So the money you pay in is already earned income, a lot like a Roth IRA, a Roth account. We've already paid income tax on that income. So the money that's in the account, the earnings on that, once it's in there, there's no tax on that. Correct. Correct. Marty?
Say I have $200,000 in cash value, I pull it out, loan it to myself, and a year later I earn 8%, $8,000. Can I take that out too?
You could, right? So what'll happen is that'll tack onto your cash value, right? So depending if you're still paying money into it or not, any interest earned, right? As you see that cash value grow up to 8,000, it's reinvested into your account. Whatever you have in cash, that is accessible anytime you want.
Basically, I don't have to return money, I pull it back out again.
Correct.
Taking interest away as it's growing.
Correct. Correct. If you do pay it back, any amount, you'll see it work just like a line of credit. You pay anything back, it's immediately there again. But to answer your question, no. If the interest is reinvested, it's there, you can pull it out again, as it's your money. Question in the back? Yeah, so the main thing would be that modified endowment contract, that MEC. So if we abuse the plan or we overpay it, right, we don't set the limit up right, once we reach that MEC status is taxable, that's permanent, we're stuck there forever. So if that happens, the growth would still be tax deferred, just anytime we pull anything out, we have the taxes and that 10% penalty as well for under age 59 and a half. Question in the back. Yeah.
For this MEC or MEC limit, why would anyone that said it's super high? Like, what does that involve with? You know, why would he set $8 million?
Yeah.
What judge would make that?
Yeah, good question. So his question was, why not set the MEC limit at $8 million or a super high number? Reason being is what has a direct relationship to that limit is the total amount of life insurance. So to set that limit very high means we have to have a higher death benefit, which comes at a cost in one way or another. So if we don't hit it, you'll see that cost can sometimes eat into our insurance expenses. Or cash, go ahead.
One more, I'm sorry.
You're good.
Can you change that limit? Like throughout the time, once it's set, it's set. If I think, oh man, I want to increase it.
So you can never increase it. The first 90 days you can decrease it, but once it's set, you cannot increase it. Yeah. Yeah, no, that's as aggressive as the insurance company will allow. So his question was, how much cash can I get on top of my premium? And you'll see insurance companies, the maximum they will allow is 10 times that minimum premium. No, we do add term insurance to do that, but as long as one knows what we're doing, then we can chop that term off appropriately.
So, Steve, if somebody was thinking about growing this long term, and they're thinking about tranches, is the way I'm thinking about this. If I'm going to buy a piece of real estate and I want to add to it each 5 years, and I was worried about whether I'd be insurable to be able to do
Yeah, good question. We get that quite often, right? So I know I'm going to inherit, right, $300,000, any amount of money down the road, or it's going to be a windfall, sell a piece of property, is we will construct the policy up front, right? I want the ability, Steve, to throw in 300 grand 6 years from now because I know that money's coming. It's an agreement, whatever. So I'm going to design the policy one with that MEC limit, that tax limit of 300K. And to do that, I've got to make sure I have what? A minimum insurance expense of 10% of my desired contribution. One more from Dad in the back. We can eat. Feel free to ask questions. We've got team members at just about everyone's table. You can come over and talk to me as well. We will eat. As far as the agenda for the rest of this evening, we do have 2 individuals that are going to be speaking as well, giving a presentation on what they do. We have Dr. Gordon Chu and also Matt Schiff, which I will introduce both you guys prior to coming up. For now, let's eat, and thank you all again for coming.